Wall Street is getting greedy again. The bankers, hedge funds, private equity giants, and billionaire CEOs, they all learned nothing from 2008. Or maybe they learned the most important lesson of all, that no matter how reckless they get, they'll always be bailed out. Today, the same dangerous behavior that nearly collapsed the global economy is happening again, but this time it's dressed up in new financial engineering, new tech hype, and a cutthroat CEO culture that treats the market like a personal scoreboard. And if history has taught us anything, it's this. When greed takes over on Wall Street, disaster is never far behind. So let's break down how Wall Street's behavior today could set off the next financial crisis. The return of too clever. Financed back in the early 2000s, Wall Street engineered something brilliant or insane, depending on how you look at it. They took risky subprime mortgages, bundled them into complex financial products, slapped them with AAA ratings, and sold them to investors worldwide. The bankers got rich. The ratings agencies got paid. Everyone thought the system was safe until it collapsed in 2008. Today, the same playbook is back. Instead of mortgage-backed securities, the new playground is private credit and leveraged loans. Private credit is basically Wall Street lending money directly to risky companies, often with little transparency and without the strict oversight banks face. In 2007, this market barely existed. Today, it's worth over $1.7 trillion, bigger than the entire junk bond market. And just like subprime mortgages before, these risky loans are being chopped up, repackaged, and sold to investors as safe. The corporate debt time bomb. But it's not just private credit. Corporate America has been binging on debt like never before. For over a decade, with near zero interest rates, companies borrowed trillions. Not to innovate, not to expand, but to buy back their own stock, making their earnings per share look better and their CEOs richer. Apple, Amazon, Disney, even McDonald's. All borrowed billions to pump their numbers. Now interest rates are higher, and refinancing that mountain of debt is painful. Many companies are already on the edge of default, and because Wall Street has sliced and spread that debt across the entire financial system, one wave of defaults could trigger a domino effect. The CEO Hunger Games. But here's where things get even more dangerous. CEOs today aren't just running companies. They're competing in the CEO Hunger Games. Their stock price is their scoreboard. Their compensation packages are tied to short-term results. Their legacies depend on outperforming rivals at all costs, and in this game, winning means manipulating. That's why we see earnings manipulation everywhere. Want aggressive accounting tricks, inflated revenue recognition, cost-cutting masquerading as efficiency, and endless stock buybacks. Because if a CEO misses Wall Street's quarterly expectations, their stock tanks, their bonuses evaporate, and their reputation takes a hit. So they cheat. Not necessarily illegally in the end, but just enough to make the numbers look good. WeWork's Adam Neumann sold investors on a fantasy of a tech revolution. Elon Musk has promised full self-driving next year for nearly a decade. And countless CEOs quietly shift expenses, fudge growth projections, or lean on hype to juice valuations. It's a toxic, over-competitive culture where reality matters less than perception. And when every CEO is playing the same dangerous game, the entire market turns into one giant illusion. Wall Street's new casinos. Now let's talk speculation. In the 2000s, it was housing. In the 2010s, it was unicorn startups. Today, it's meme stocks, crypto, and AI. The casino mentality is back. This time is different. The bubble will never burst. AI is the perfect example. NVIDIA hit a $3 trillion valuation. Investors are piling into anything with AI in its name, just like they did with dot-com stocks in 1999. Companies that barely touch AI are rebranding themselves as AI-driven. CEOs are promising revolutions, and Wall Street is eating it up. Crypto is no different. Despite countless scams and collapses, Wall Street is pushing Bitcoin ETFs and opening the gates for even more speculative frenzy. And then there's meme stocks, GameStop, AMC, and the new wave of short squeezes sparked by social media influencers. They should have died years ago, but the casino is too addictive. These aren't signs of healthy markets. They're signs of a speculative mania fueled by greed, competition, and blind optimism. The rise of shadow banking. After 2008, regulators forced traditional banks to play safer, more capital, stress tests, oversight. But Wall Street always finds a loophole. Instead of taking risks directly, banks shifted trillions into shadow banking. Hedge funds, private equity firms, and non-bank lenders that operate in the dark, with almost no regulation. Today, shadow banks control more than $65 trillion globally. If something breaks in shadow banking, there are no safety nets, no stress tests, no emergency lending facilities, just contagion, which means the next crisis might not even start in banks. It could erupt from the shadows. Greed without fear. But the most dangerous thing isn't debt, speculation, or even shadow banking. It's psychology. In 2008, Wall Street was terrified for a moment. Lehman Brothers collapsed, Bear Stearns vanished. The system nearly melted down, but then government stepped in. Bailouts, money printing, zero interest rates. Wall Street learned the lesson. No matter how reckless they get, they'll always be saved. And so today, there's no fear. Bonuses are back, excess is back, risk is back. When CEOs are locked in a dangerous competition, when earnings manipulation is normalized, when speculation is celebrated, and when greed has no consequences. What the next crisis could look like. So what does the next crisis look like? It won't be identical to 2008. History doesn't repeat itself, but it rhymes. Instead of housing, the trigger could be corporate defaults, or an implosion in private credit, or a collapse in overhyped AI stocks, or another crypto meltdown that spills into the mainstream. Whatever the trigger, the pattern will be the same. Investors panic. Liquidity dries up. Markets crash. Governments step in. Ordinary people lose their jobs, homes, and savings. Wall Street walks away with bailouts and golden parachutes. Wall Street is getting greedy again. Just like before 2008, everyone thinks the system is safe. Regulators are asleep. Investors are blinded by hype. And CEOs are locked in a destructive competition where manipulation beats honesty. The next crisis won't look exactly like the last one. But the ingredients are already here. Excessive debt, rampant speculation, shadow banking, CEO hunger games, and unchecked greed. When fear disappears from the market, it's only a matter of time before reality comes crashing back. And just like before, it won't be Wall Street who pays the price. It'll be you. Thank you for watching and liking this video. Please stick around for the next video.